Rockefeller Center is a complex of 19 commercial buildings occupying 22 acres in Midtown Manhattan between 5th and 7th Avenues and 48th and 51st Streets. It was built between 1930 and 1940 by John D. Rockefeller Jr. at a cost of approximately $250 million, the largest private building project in American history during the Depression era, and one of the most consequential acts of urban development in the history of the country. The complex became the defining example of Art Deco urbanism in America, a collection of towers organized around public plazas and connected by underground concourses whose design principles influenced commercial real estate development for the remainder of the 20th century. In October 1989, Mitsubishi Estate Company of Japan acquired a 78% controlling interest in Rockefeller Group, the company that owned and managed Rockefeller Center, for approximately $1.4 billion. The acquisition made front pages across the United States. It was described in editorial columns, political commentary, and public discourse as a symbol of American economic decline and Japanese economic ascendancy, as evidence that the United States was losing its most iconic assets to foreign capital, and as a cultural provocation that the architecture of American ambition was being purchased by the nation that American manufacturing had displaced. 5 years later, Rockefeller Group filed for bankruptcy. The forensic entry point for this case is the gap between the cultural meaning of the acquisition and its financial mechanics, because those two dimensions of the Rockefeller Center story were almost entirely disconnected from each other. And the disconnection produced an outcome that neither the cultural commentary nor the financial analysis had adequately predicted. The cultural commentary treated the acquisition as a geopolitical event. The financial analysis should have treated it as a leveraged buyout of a real estate portfolio with a specific and challenging cost structure. Neither framework adequately priced the property tax. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The Rockefeller Group's capital structure at the time of the Mitsubishi Estate acquisition had been assembled through a series of transactions that reflected the specific characteristics of the late 1980s commercial real estate market rather than the specific characteristics of Rockefeller Center as an operating asset. The buildings in Rockefeller Center were subject to a ground lease with Columbia University, which owned the land beneath the complex. The ground lease required annual payments that represented a significant fixed cost of operating the center regardless of the occupancy or rental income the buildings generated. The property tax obligations on the Rockefeller Center buildings were among the largest of any commercial complex in New York City, reflecting both the assessed value of the properties and the specific tax treatment that New York City applied to commercial real estate in Midtown Manhattan. The debt service obligations that the acquisition financing required were sized to a Midtown Manhattan office market that was approaching the end of the longest commercial real estate expansion cycle in the city's history. The combination of ground lease payments, property taxes, debt service, and operating costs created a fixed cost structure that required the Rockefeller Center buildings to maintain occupancy and rental rates at levels that the Midtown Manhattan office market of the early 1990s, following the collapse of the 1980s expansion cycle, was unable to sustain. The covenant that Mitsubishi Estate did not read carefully enough was not written in any loan document. It was written in the New York City property tax assessment rules, which imposed on the owners of Rockefeller Center an annual obligation that did not decline when office market rental rates declined, when occupancy fell, or when the broader real estate market entered the severe contraction that the early 1990s recession produced. Property taxes on commercial real estate in New York City are assessed based on the city's determination of market value, which the assessment process adjusts with a lag. That means owners pay taxes reflecting peak market conditions for years after the market has corrected below those conditions. Mitsubishi Estate had paid $1.4 billion for 78% of a company whose fixed cost structure was designed for a market that the 1990s recession had already begun to dismantle. At the time the acquisition closed, At what point does the cultural prestige of an acquisition become a liability that prevents the acquirer from accurately pricing what they are buying? Leave your analysis in the comments below. The appraisal methodology that justified Mitsubishi Estate's $1.4 billion investment in Rockefeller Group shared the foundational error documented across this channel's case file archive, but expressed it through the specific lens of Japanese corporate decision-making in the late 1980s, when the combination of the Plaza Accord's yen appreciation, the Bank of Japan's accommodative monetary policy, and the extraordinary asset price inflation of the Japanese bubble economy had created a capital surplus that the Japanese corporate sector was deploying in international real estate acquisitions at prices that reflected the cost of capital in the bubble economy rather than the earning power of the assets being acquired. The stabilized net operating income projection that justified the Rockefeller Center acquisition was built on rental rates and occupancy assumptions calibrated to the late 1980s Midtown Manhattan office market, a market that had been driven by the financial services sector's extraordinary growth during the 1980s expansion cycle, and that was already showing early signs of the contraction that the savings and loan crisis and the broader recession would accelerate. The property tax assumption embedded in the acquisition model treated New York City's commercial property tax as a fixed and predictable cost, which it was in the sense that the legal obligation to pay it was fixed and predictable. The assumption was inadequate in the sense that it did not adequately model the interaction between the fixed property tax obligation and the variable rental income, a combination that produces acute cash flow stress when the rental income declines while the tax obligation remains at the level reflecting the prior market peak. The Rockefeller Center buildings were among the most expensive commercial properties to own in New York City on a per dollar of rental income basis, because their iconic status, their historic designation, and their Midtown location produced assessed values that the tax system treated as stable indicators of earning capacity, while the office market was treating them as declining indicators of tenant demand. The acquisition model's treatment of that cost structure as compatible with the returns that Mitsubishi Estate's board had been promised was not the product of analytical error in the conventional sense. It was the product of a capital surplus that had reduced the effective cost of capital in the Japanese corporate sector to a level at which almost any internationally prestigious asset appeared affordable. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The cultural reaction to Mitsubishi Estate's acquisition of Rockefeller Center in 1989 was the most intense public response to a foreign real estate investment in American history, exceeding even the reaction to the Waldorf Astoria's acquisition by Anbang. That case file 003 documented. The intensity of the reaction reflected the specific symbolic weight that Rockefeller Center carried in the American cultural imagination, a complex built during the Depression by one of the defining figures of American capitalism, home to NBC's broadcasting operations, the site of the annual Christmas tree lighting, and the location of the top of the Rock observation deck, was not merely a commercial real estate portfolio. It was a piece of American civic identity. The editorial response treated the acquisition as a form of national humiliation. The economic analysis treated it as evidence of American fiscal irresponsibility and trade policy failure. The political response treated it as a justification for trade legislation that would restrict Japanese investment in American assets. What none of the cultural and political response adequately addressed was the financial reality. Mitsubishi Estate had paid approximately $1.4 billion for 78% of a company that was structurally unable to generate sufficient net operating income to service the combined obligations of its ground lease, its property taxes, its debt service, and its operating costs under the market conditions that the early 1990s produced. The institutional denial in this case was embedded in the cultural response itself. The public discourse's treatment of the acquisition as a geopolitical event rather than as a leveraged real estate transaction prevented the accurate financial analysis of the acquisition's viability from reaching the level of public attention that might have produced either a more cautious acquisition price or a more rapid recognition of the financial difficulty that followed. Mitsubishi Estate invested additional capital in Rockefeller Group after the acquisition to support the company's operations as the office market contracted. Those investments extended the timeline of the eventual default, rather than resolving the structural cost problem that the acquisition model had underpriced. The bankruptcy filing came in May 1995, approximately 5.5 years after the acquisition closed, as Mitsubishi Estate determined that continued investment in the support of a capital structure that the operating market could not sustain was no longer consistent with its fiduciary obligations to its own shareholders. The Rockefeller Group bankruptcy was resolved through restructuring that transferred the equity interest from Mitsubishi Estate to the company's creditors and produced a recapitalized ownership structure whose debt basis was significantly lower than the acquisition price Mitsubishi had paid. The recapitalized Rockefeller Center was subsequently sold to Tishman Speyer Properties and a group of investors, including Goldman Sachs, in 2000 for approximately $1.85 billion, a price that reflected the recovery of the Midtown Manhattan office market during the late 1990s technology and financial services expansion, and that established a new debt basis for the complex. The complex continues to operate as one of the most commercially successful mixed-use developments in American real estate. The ground lease with Columbia University remains in effect. The property taxes remain among the highest of any commercial complex in New York City. The Christmas tree is still lit annually in the plaza between the towers. What the Rockefeller Center case reveals in the context of this channel's 26-case archive is the specific risk of a cultural acquisition, a transaction whose primary motivation is the purchase of prestige and symbolic significance, rather than the acquisition of cash flows at a price that those cash flows can service. Every previous case file has documented a transaction in which the acquirer believed the financial analysis supported the price. The Rockefeller Center case documents a transaction in which the cultural significance of the asset appears to have been a primary driver of the acquisition decision, in a context where the financial analysis, even if conducted with complete accuracy, might not have altered the outcome because the acquisition's objective was not primarily financial. Mitsubishi Estate lost approximately $2 billion on its investment in Rockefeller Center by the time the bankruptcy proceeding concluded, a loss that represented a significant portion of the company's equity capital and that contributed to the broader reassessment of Japanese overseas real estate investment that the 1990s produced. The buildings are still there. The plazas are still there. The Christmas tree is still there. The lesson that cultural prestige and financial viability are separable variables in real estate valuation is still there too, documented in the bankruptcy court filings of May 1995, available to any acquirer willing to read them before submitting a bid. If this case file changed how you evaluate the relationship between cultural prestige and financial viability in iconic real estate acquisitions, subscribe to this channel because the next case examines what happens when a city decides to build a monument to its own ambition and cannot find the tenants to fill it. And in the comments, given the specific interaction between Rockefeller Center's fixed cost structure and the variable Midtown office market of the early 1990s, what specific covenant in the acquisition financing would have most effectively limited Mitsubishi Estate's exposure to the market downturn that followed the 1989 purchase? The case file is open.